So the next few chapters in our book, Next Gen Dollars and Cents, start to focus on some of the financial and economic concepts that you need to know when it comes to your money. So chapter 11 in our book discusses rates of return and economic cycles and contains a variety of charts and graphs to really help explain these topics. You know, in the short term, certainly stock markets and stock market returns are always uncertain, but over time, investors experience positive results. If you look at the 100-year history of the stock market, it has prevailed despite numerous dramatic headlines and events because of the fundamental resiliency of human beings and, in corollary, the global economy as well. Its track record is pretty good. In fact, if you think back through history, there's never been a time where the stock market hasn't fully recovered over time from a prior decline. Let me say that concept again. The stock market has always fully recovered over time from every one of its previous declines. Pretty good track record when you stop and think about it, particularly when you think about some of the headlines that have happened over the course of the past 100 years, right? A couple of world wars, multiple conflicts, numerous acts of terrorism, political scandals, and the like. Yet, through it all, the stock market has persevered and continued on throughout history. And I think that's a testament to the fact that the market really does reflect that growth and that innovation that is inherent in humans and human behavior, and certainly creates a tremendous amount of value over time. To a considerable extent, then, the market sort of ebbs and flows alongside the underlying economic cycle, which the economic cycle obviously has periods of expansion and contraction during economic growth, right? Corporate earnings are going to increase, stock prices are going to rise, and conversely, during economic downturns, earnings of companies are going to go down, investor pessimism is going to peak, and stock prices are going to fall. The good news is that expansions prevail over the long term, and certainly have contributed significantly to the overall sustained upward trajectory of the overall markets, assuming that you are a consistent investor. You know, when we think about the rates of return and over time, they really are pretty impressive. Bull markets, which are periods where the market increases, typically last an average of 67 months and produced an average total return of 265%. On the other hand, bear markets, periods when the markets decline, last only 13 months and result in an average decline of about 33%. Certainly an impressive history of recoveries that lasts much longer than declines. And Chapter 11 of our book certainly does have a lot of charts and graphs in it that really help to kind of see these concepts in those types of forms, which are oftentimes a little bit easier to understand than just kind of a few sentences. One of the things that the chapter also talks about is sort of the average performance of stocks and bonds over time. And the reason that that's important is that helps investors sort of differentiate among the investment choices. So we start out with inflation as measured by the Consumer Price Index. Inflation over the course of the past 100 years average a little bit less than 3%. Short-term treasury bills, on the other hand, slightly more than that 3% number. So short-term treasury bills typically stay a little bit ahead of inflation. Longer-term U.S. government bonds, and if you recall our video on our chapter on bonds, you know that longer maturities, longer-term bonds carry a little bit more risk, right, than a shorter term bond, and so consequently would then earn the investor a little bit more of an interest rate. So longer term U.S. government bonds, typically somewhere between 5-6%, depending upon the exact maturity, but over the course of the past 100 years. If we then look at large company stocks and how they have performed over the course of the past 100 years, you see the return going up a little bit more to nearly 10% over that period of time. Small companies have also delivered an even better return, somewhere in that 11 to 12% over that period of time. The reality is that as the return goes up, right, the risk or the volatility also goes up. And certainly their past performance is no guarantee or predictor of the future. These rates of returns are certainly useful tools, though, for investors to decide among different types of investments. Greater the return, the greater the potential for volatility. That trade-off, if you will, between return and the potential for volatility and the potential for decline is sort of the core balancing act that you would engage in when you determine your asset allocation. And that is what Chapter 12 is all about. So stay tuned for our next video about Chapter 12. And to see some of these numbers that we've talked about on this video in graphical form, be sure to look at Chapter 11 of our book, Next Gen Dollars and Cents. You can get your free copy of our book by texting free copy to 407-791-0070. That's 407-791-0070. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary at Nelson Financial Planning and author of Next Gen Dollars and Cents. Thanks for watching this video.